We've been talking about the European smaller companies universe, our fund, the opportunities, the alpha we've captured historically and the alpha we hope to capture going forward. There's a real concern, I think, about valuation levels in markets. We've had a very, very strong run. The fund has more than tripled since the lows. So people really want to know if we can still see opportunities, if the macro backdrop is supportive, perhaps if the central banks and liquidity remain supportive, and if we can see sustained returns into the future, really. Those have been the key issues. I think what people are always surprised by is that we're actually investing in a smaller class of smaller companies than the average small cap fund. So people are asking us why we're looking there, why the opportunity is greater there. Surprisingly few questions now about the European economy, or I don't think we've talked about the euro at all, probably for the first time in a few years. So actually, we're talking about fundamentals and opportunities, which is, I guess, what we're here for. Interestingly, we're almost the opposite way around from the market. So we've actually outperformed year to date, but we've actually held the opposite to the way the market is. So where the big returns have been Italy and basically the whole of the south. We're still positioned towards the north. The reason we're there is we're looking for sustainable growth. Growth is returning, but at a very low level. What's been driving the south has been really convergence in the bond market rather than actual big recovery. So we think for the rest of the year and for the years to come, we still need to be looking for growth. And that's really driven by the big industrial economies, so Germany, Sweden, those kind of places. I think that what we've seen for the last, well, probably since last summer when we had the first wobble in equity markets, when the Fed started talking about tapering, it's quite instructive, it's quite interesting because equity markets have managed to shrug off that talk and then the start of tapering in the US. But then at the same time, we're obviously investing in Europe. It is a global market, but in Europe, we've got the ECB talking louder and louder about either deposit rate cut or some form of QE. Generally, when one of the great things that Mario Draghi does is he talks to the market, he sounds the market out. The fact that we've had both the head of the Bundesbank and the German finance minister talking about QE suggests I think we are going to see more liquidity in Europe, which will offset the drain that we see in the US. And underpinning all this, even if we didn't have QE, we've still got very, very accommodative central banks. So actually pretty supportive for equity markets. I think we're still very, very fearful of deflation. So actually, if those growth rates move from, on average in Europe to 1.5 to 2 to 2.5 to 3, which is more like creative potential, that should be good. We should see operational gearing for companies, sales growth should be faster, and we should see much higher earnings growth. Companies are very lean. They should benefit actually as the economy picks up.